Hello everybody, welcome to the official TPD video. Now TPD actually stands for Terminus Price Divergence. So before we get started, if you came into this video with a pessimistic mind, I challenge you to backtest the things that I'm saying in this video to see if they really work or not. And if they don't, then I give you full permission to publicly slander my name. But with that being said, as always, I'm not here to waste your time, so this video is going to be short and straight to the point. Getting started with how markets efficiently deliver. Every asset within an asset class feeds off one another to gauge information. In order for markets to reverse, there must be a cracking correlation between these assets before efficient repricing and delivery. Once this cracking correlation takes place, markets are prone to reversing and expanding. So with knowing that, it's important to only focus on certain assets depending on the trader you are. So if you're an index trader, then you mainly want to focus on the S&P, the NASDAQ, and the Dow Jones. But if you're a Forex trader, then you mainly want to focus on the US dollar, the euro, and the pound. So you're comparing these assets, looking for a cracking correlation for efficient price delivery. Understanding SMT. So SMT is the easiest cracking correlation to spot. SMT is simply a cracking correlation on old highs and old lows between two assets. So as you can see in the diagram, the asset on the left, which would be asset 1, took out the previous low, while the asset on the right made a failure swing. And then it would be vice versa, for if it were bearish, the asset on the left would take out a high, while the asset on the right would create a failure swing, not taking out that high. And SMT is one of the key fundamental principles for TPD, but TPD and SMT are only important in regards to time. So especially SMT is only important if it is the previous week's high or low, the previous day's high or low, or the previous session high and low. So on the right is what it would look like through the lens of a lower time frame, but on the left, as you can see, this is what it would look like through the lens of a higher time frame. So all you would see is two candles, and then the candle that creates an expansion is the one that creates an SMT to the candle to the left of it. And this is the most important section of this video. It is very important that you only look for SMT in regards to time specific highs and lows. But if we zoom in there on those two candles, and we add a third one into the picture, as you can see, now there are 3 candles on the screen. And no, this is not to get confused with candle range theory. This is completely different. And if anything, this actually tells you whenever candle range theory will work. And now applying that same logic of SMT between highs and lows, we can also do that, but viewing it through the lens of a higher time frame. So view each of these candles right here as either a daily or weekly candle. As you can see, the asset on the left created a stop run, while the asset on the right created a failure swing, making that SMT. But for one moment, I want you to pause the video and really observe the diagram and write down what you see. If you said the cracking correlation between the close of the first candle and the opening of the third candle, then you would be correct. As you can see, the asset on the left, the opening of the third candle is lower than the close of the first candle, and vice versa for the second asset. And this is the TPD sequence. So TPD is a cracking correlation between the close of candle 1 and the opening of candle 3. So the entire sequence is made up of 3 candles. You have the first one, the second one, and the third one. And you aren't going to know immediately right away if a TPD is valid until that third candle opens up. So if a TPD forms on the daily time frame, then that can give you insight on whether or not a day will expand and which direction it is likely to expand towards. This is how you really find explosive moves in price action. The turtle soup secret. So putting everything together and taking everything into account, once you have that cracking correlation between candle 1 and candle 3, if bullish, the asset that creates the lower open will run the stops of candle 2, and if bearish, the asset that creates the higher open will run the stops of candle 2. So once you have a TPD in place, that is whenever you actually can see real SMTs, the ones that actually work. So you're looking at a multi-stage cracking correlation, and once that forms, price is prone to expanding and reversing. So now we're looking at the chart. We have the S&P on the left and we have the NASDAQ on the right, and we're looking at the weekly time frame. So focusing on these three candles right here, we can see there is that cracking correlation between candle 1 and candle 3. So the S&P for candle 3 creates a lower open while the NASDAQ creates a higher open, giving insight that the NASDAQ is likely to run the high of candle 2 while the S&P is likely to create a failure swing on candle 2, and that is exactly what happened. So viewing it through the lens of a lower time frame perspective, we can see that the NASDAQ traded above this high right here, which would be the previous week's high, and then made a very large expansion, while on the S&P, it failed to take out these highs and then created the expansion. So hopefully you found this video insightful. Good luck and good trading.